Okay, awesome. Let's get started. Hey, everybody. My name is Tomasz Tunguz. Welcome to Office Hours. I'm your host. This is a program where we invite luminaries from all over the startup world to share insights. We've been hosting these for about 5 years with lots of success, and in the past, we've hosted exceptional leaders like Claire Hughes Johnson, who is the former COO at Stripe, Holly Wegman, the VP of Marketing at Segment, GC Lionetti, the CMO from Confluent, and many others. I'm really excited about today's office hours because we have more than 700 registered guests, which is absolutely enormous. But this office hours is exceptional in another way in that we don't have a guest. Instead, we're going to review a bunch of interesting data about what's going on within the ecosystem. A little bit about me. I founded a startup. I was an early employee at Appian and then Google as a PM, and I've been a venture capitalist at Redpoint for 14 years. I've written a book called Winning with Data with Frank Bien, who is the CEO and the CEO at Looker. And I write a blog at tomtungus.com, which reaches about 1 million people every year. I've been lucky enough to partner with 7 unicorns from the early days of their evolution, and I consider myself a student of startups, and I'm thrilled to be talking to you today. So let's talk about the format of this episode for Office Hours. Today we're going to be reviewing the survey that we kicked off last week called the 2022 Market Conditions Survey. I've got a presentation, it's a short presentation of about 20 data points to shed light on what's going on within the ecosystem, and we'll spend about half an hour talking about that. There are 3 things that we really want to cover. The first is how founders are feeling about the market, how startups are reacting to it, and what's happening in the fundraising market. Interspersed within this presentation are 3 different polls. I want your opinions, and we'll be discussing them and comparing them to the data from the survey to see whether it's consistent. So please do pay attention. The answers are anonymous, so they're not tied to your user ID. So please don't feel pressure to answer if you don't want to, but if you do, it's better for everybody if you answer truthfully. And thank you to everybody who registered and submitted questions. I've gathered all those, coalesced them into some of the answers in the presentation. So the first half is going to be focused on the slides, and then the second half will be an open Q&A through the Zoom Q&A feature, which is at the bottom. If you've got questions as we go, please put them in the chat. I have that up here to my right, and I'll answer them as we go along. One last note, we are recording the session, and that's to share it in the future. Great, now we can kick it off. Any questions before we get started? Fantastic. Okay, so there are 3 sections that we're going to be covering in the data. There's going to be what's going on in the public market, the survey data, which is how founders are responding to the public market, and then an analysis of the private market, which is what's going on in VC land. To give you a sense, if you haven't heard, the public markets have changed enormously in the last 3 months. We could talk about many different things happening. There's the geopolitical conflict, there's a changing monetary policy with interest rates rising, and there's also the end of a decade of quantitative easing where the Fed has increased the money supply by about 30%. And this has had a huge impact on the way up for the public markets and on the way down. This chart shows the forward revenue multiples for publicly traded software companies over the last 6 years. You can see on the left-hand side in 2016, most of the multiples were around 5 times forward, which means the enterprise value of the business divided by the sum total of the next 12 months of revenue is about 5. And as a result of all the different policies, we saw a huge increase all the way up to 30 for the top quartile. The top stock actually touched 88 times forward. Absolutely massive expansion on the top. And throughout all this, you can see there are definitely ups and downs. We'll talk about that and what it means and how to interpret it. But the real story is what's happened since 2021 down to 2022. The top, we've seen a pretty significant correction. The one thing I'll mention here is if you look in the data, there have been 4 corrections before within the decade of 2010. Not all of them are shown here. There was one in 2014, 2016, 2018, and 2020. Each of those were about 30 to 50% corrections. Each time those corrections were V-shaped. In other words, within a quarter, the public multiples were basically back to the same place. The prevailing wisdom today is that this is not going to be a V-shaped recovery, and we'll talk about why later. To present the data in a different way, valuations have fallen somewhere between 57 and 70% for software companies. Now, why does it matter to look at what's going on in the public markets? The reason is because as investors, we VCs, when a startup comes in to pitch, we create an investment case. We create a memo to say, this company is really exciting. We ought to be investing in it. We try to predict the future of what that company could be worth. And in order to do that, we need to look at benchmarks. We need to say this company is competing with CRM and Salesforce is this large, and if they capture this percent of the market, then they'll be valued like this. When those benchmarks fall, then so do the valuation cases and the projections in the memos. And so for us to make the same, us as venture capitalists to make the same case to our investment committees that we're going to drive a great return, prices have to change. And so there's a tension now between startups who we're raising and have expectations around certain prices and what's going on in the public markets. So when your comparable companies have fallen 60 to 70%, the question on everybody's mind and the most popular question that people submitted was, what is the private market going to do? And the answer is we're figuring it out. And the goal of this survey and the goal of this session is to at least shed light on some of the murk that's going on. There's no clear answer, but there's some interesting suggestions. So let's start with the first poll. I want you to pretend you're a VC and answer this poll. You know the NASDAQ has declined by about 50% or more. You've just come to present a company to your investment committee, and people are wondering, what is your take on the NASDAQ? So let's open this poll. Let's see, I'm going to start it. It's on a 1 to 10 scale. So 1, you're absolutely depressed about the market. 5, you're neutral on the market. And 10, you're absolutely ecstatic. So, okay, we'll just give it here. We've got 20% of people participating already. Fantastic. Thank you so much. We'll call it at 75%. Okay, great. So we got 78% of people participating. And let's see. We've got 31% of people at 3, 24% of people at 4, 21% of people at 5. So let's call the average 4. Okay, so most people are negative. They're less than neutral. They're actually negative on the market. So comparing that, you'll be interested to see, oh, well, let's go into it. We'll get into that later. Median founder feel a bit more positive than this audience on the phone. Most founders are on a 6 out of 10 compared to a 4 out of 10 with people dialing in live, which is interesting. We didn't run this survey 6 months ago, but I bet if I did, the answers would have been 8 or 9. And the reason is companies were growing really fast. The fundraising market was super hot. M&A was vibrant, and the IPO market was open. And so you can see even between like when we ran the survey and how people are feeling this morning, there's quite a bit of difference, and that's evidence of what's going on in the market. There's a bunch of volatility. The interesting part about the data that we collected in the survey was that this feeling actually varies significantly by segment. So if you're a Web3 or a crypto founder, you're the most bearish on the market. You're at a 4.5. Whereas if you're an infrastructure or a software company, you're actually the most bullish at about 6. And so, why is this? A couple hypotheses. If you're working in crypto, you've seen a couple of winters. You've seen at least 3 winters, and some of these can be relatively drawn out. So perhaps you're drawing the same inference about what's going on in crypto by comparing, what happened the last 3 times. Software and infrastructure companies are the most bullish. There's a couple of reasons here. The first is they typically tend to have longer contracts than a consumer service or Web3 crypto company. They're signing single-year and multi-year deals. The second reason is that the public market comparables are actually doing pretty well on a revenue basis, so the businesses are actually healthy. And so to give you a sense of that, like the concept that I have when I look at the public market is, and trying to map whether or not that's going to be helpful to startups or whether or not startups are going to survive, is really looking at, like, the ideal thing you would want is an index of buyers. Right? If you're selling software infrastructure, you really want to know across the entire ecosystem, what are the behaviors of software buyers and how they're changing? This was a question that many people asked also. And if you look at what's going on, if you look at Salesforce and Adobe and Palo Alto and ServiceNow, they're basically indices of buyers because they're so large, because they sell to every geography, because they sell to every customer segment. They're effectively an index of what the software market is doing. And so this is a chart that shows the compound annual growth rates by quarter for Salesforce. So 4 quarters ago, Salesforce grew revenues 23%, then 25, then 22, then 23. And then they just reported, they were actually one of the first companies to report, and they reported 24. So what does this suggest? It suggests that Salesforce buyer base is continuing to practice the same behaviors they have been over the last year, which is really fantastic, right? And so what I'm doing is I'm keeping track of this for both software companies and infrastructure companies. And if I see a meaningful deviation in the revenue growth, that's going to suggest some broader headwinds and some changing buyer behaviors. But today, we haven't seen it so far. The majority of the earnings season is in front of us. A lot of it happens in mid-June to late July. So we'll see, and we'll keep track of this. Let's see. Right, so the next question on the survey we asked was about longer sales cycles. One of the things that's really important for startups to understand is, are you seeing any changes within your customer buyer base? There's the macro, which we just talked about. We're not seeing anything within the Salesforce customer population, but on an individual basis, your particular portfolio company, for your particular startup, the question is, are we seeing longer sales cycles? And this is a chart that breaks out those sales cycles by segment. So on the top, we show very small businesses, mid-market, and enterprises. You can see that in mid-market and enterprises, 36 and 31% of the respondents are seeing longer sales cycles. And then about half of businesses who responded are seeing no change, and maybe 20% or so, 15 to 20% are actually seeing an acceleration. So why is this? Half of the companies aren't seeing a change, right? Certain sectors are going to be so some companies are selling software that is essential. You need it in order to survive. And so that's really not going to change. Another reason we may not change is it takes time to implement cost-cutting programs. And so those cost-cutting programs, they may not appear yet, right? A third reason is the customer base is actually just really healthy, right? So let's take the inverse. Like, why would you see a longer sales cycle? You might be selling to retail. And if you're selling to retail, you're looking at Walmart and Target guiding down, saying that they've got lots of excess inventory. And so you could say that maybe that expands to the entire retail population. And so it might be more difficult to sell software into retail. We didn't capture the survey results by sector, but those are some of the hypotheses of this survey. Brian, the answer to your question is that we took the survey last week. So people have been responding for the last 7 days. And Mason, the answer to your question, which is, was the market survey for founders only? The answer was anybody could respond. People said what their function was, and then I filtered the results to limit it to founders. Okay, cool. Keep asking questions. So, at a high level on this slide, you're seeing 30% of respondents seeing longer sales cycles. And so it's like, I wouldn't call this data catastrophic, but it is suggestive that there is something going on within the ecosystem that's happened over the last quarter. Okay. Cool. As a result of that, and as a result of the global macro conditions, about half of startups are forecasting slower ARR growth. And of the ones who are forecasting slower ARR growth, they've cut their plans by a third, by 30%, which is really significant. And if you think about this, like, we'll get into valuations in a little bit, but the valuation market, the comps have actually declined, right? And now what's going on is a significant chunk of the startup population is decreasing their projections, right? And so those are both factors that should suggest that valuations ought to come down. We'll get into valuations later, but this is an important point. When we look at valuations, when we look at what's going on in the private market, it's not just that the public market comparables are coming down, but also startups are changing their behavior, and that both of those factors are going to influence the market. Okay, let's see. Were the respondents from mature software companies? In other words, is this also true for companies early in their life? Yeah, so we can go back to the demographics, but the answer is let's go back to demographics real quick so you get a good sense. So here's percentiles, right, of the population of 430 different respondents. The contract value ranged, the 25th percentile was about 7,000. The 75th percentile was about 88,000. Most of the companies raised between 1 and 50 million. There were some later companies. There were even some publicly traded companies that answered. And then the headcount was between 15 and 125. Okay. Cool. Okay, Ben has a question. Thanks, Ben. Can this be the case of the companies feeling the need to bring down their forecasted ARR because their plans are facing increased scrutiny from investors? Absolutely. So we'll get into this about what VCs are telling their founders, but broadly, the message that many of us have been giving to our companies is everybody needs about 24 months of cash. And so it used to be maybe 3 or 6 months ago, growth was the most important thing. Now it's a combination of growth and efficiency. And so in order to attain more efficient growth, potentially people are reducing their plans. Absolutely. And to give you a sense, I mean, when I joined the venture business in 2008, and back then in 2010 to 2012, in that era, like a top decile company was growing from 1 to 3, right? And then we got into this phase where there's just a lot more money within the ecosystem, and we started to expect companies like the top quartile, the top decile to go 1 to 4, 1 to 5, and it wasn't uncommon to see like 1 to 6, maybe even 1 to 7. And so like an open question in my mind is, are we going to see that 1 to 7 come back down to 1 to 3 to 4 because efficiency is more important, or has become an important criterion where it wasn't a quarter ago? Okay, let's see. I'm going to start answering these questions. Let's see. Do you think lower ARR expectations, Austin asks, means a focus on profit or a sign that customers are spending less? I think it's a good question. We don't have the data within the survey, Austin, to answer that question. My suspicion is it's probably driven more by the board at this point, particularly in venture-backed software companies, than it is by the market, but it's just a suspicion. Okay, cool. Okay, let's see. Lots of questions coming in. This is great. Okay, Steve asked, could you define that ratio 1 to 7? Could you clarify? I've forgotten what it was. And then let's see. Do you raise capital for the next 24 months? Abhishek, hold on to that question. We're going to get there. And then our Paul saying, if VCs are supposed to be long-term investors, then why do they force companies to make short-term decisions like growth that was popular 3 months ago and change their plan effectively? Yeah, it's a good question. So the VCs who are on the board have a legal responsibility to the startups to make sure that they're trying to do the best for the company. And if it's easy to raise money in one market and really hard to raise money in another market, the most important thing you can do as a board member is get the company to survive through that period. And so that's why sometimes boards and companies and management teams decide to change strategy, because we've got to be cognizant of what's going on within the fundraising market. Okay, cool. Let's keep going, because we're going to jump into the next poll. I've got to find the poll widget. Where is that poll widget? Okay. Cool. Okay, so we've talked about what's going on in the public markets. We've talked a little bit about startup behavior. So you've got half of companies reducing their plan. Average plan reduction is about 31%. You got a 50 to 70% reduction in public market comps. How much do you think, I'm going to launch this poll. How much do you think fundraising prices will change? So if you were going to raise a round January of this year, and now you decide to delay it and you're going to raise it in June, how much will your pre-money valuation have changed? And there are 5 buckets here. I'm launching the poll. Again, we'll call it at 75% of people participating. So it can either increase, here are the choices: increase by 25%, increase between 0 and 25%, no change, decrease by 0 to 25%, or decrease by more than 25%. Thank you so much for your votes. It's so fun to watch it in real time. Awesome. Okay, so we're at about 70%. Half of people say it'll decrease by more than 25%, another 36%, so basically 90% of people say, 90% of the population says it can decrease by somewhere between 0 to more than 25%. Okay, thank you so much for your participation. That's great. So, founders, much more optimistic. So what this shows is, across the bottom, we've got the predicted valuation decline. So if you take it from the 25-0, that means somebody thinks it's going to drop by 25%. The next one on the left is drop between 25 and 50%, and so on. And 89% of founders believe that the market will decline, which is consistent with what the audience said, which is great. Of the people who do believe it's going to decline, on average, people think it's going to decrease by about 11%, which is a lot lower than I would have, a lot less than I would have thought, right? You've got the backdrop of a 50 to 70% comp correction and an 11% correction in startup prices, right? So the question is why? Well, if you ask someone if they're an above average driver, the odds are they're probably going to say yes, right? And we all know mathematically, not everybody can be above average driver. And so maybe this is a case of founders believing that they're going to beat the odds. We all love that sentiment. It's great. It's at the core of a founder. And so that might be coming through. My sense, like, you know, a bunch of people asking the questions like, hey, what's going to happen in the market? My sense is that prices are going to fall somewhere around like 30 to 50%. Now, why do I say that? A couple different reasons. The public markets work differently than the private markets. In the public markets, you need lots of people to agree on a price just because there are so many, like if you trade in Google stock, the volume is billions of dollars a day. And so there are lots of people clearing transactions. In the private market, only one person had to set the price, right? So I could offer to lead around at 20 million pre, and then another VC who's a friend of mine could offer 40 million pre for the same company, and then 40 becomes the market clearing price. Only one person needs to do it. And so that's going to sort of slow the decline or increase the speed on the way back up, right? The other reason is there's significant competition still in venture land. There's quite a bit of dry powder. This is another question, how much dry powder it is, what is it going to impact? What does it mean for the dynamics within the ecosystem? And there's a lot of dry powder, and people, you know, they want to get promoted, they want to have returns, they want to generate capital for their investors. And so that competition and the fact that the auction is different means that the private market won't map one-to-one what's going on with the publics. But, you know, what I think, going back to the point we were talking about before with the ARR decline, it doesn't necessarily consider changes in plans, right? So maybe one of the differences why people on the phone here on Zoom are so different is we kind of talked about this point that a lot of companies are changing their plans, and maybe that wasn't taken into account by some of the respondents here. Okay, let's see. Just checking the chat real quick. Oh yeah, Steve, your question. I said revenue. So like a top decile company used to grow from about 1 million to 3 million in annual recurring revenue, and then through the course of the 2010s, it went from 1 million in annual recurring revenue to 5, and this is like roughly around the Series A, and then it went from 1 to 7, and that revenue might decrease. Okay, Matthew and Helena asked the same question, which is when you say 30 to 50% decline in valuation, do you mean in multiples or value? It's basically the same thing because you're just multiplying numbers. So yeah, it's in valuation. It's my guess based upon what I'm seeing in the market. But you'll see there is sort of an exception to it, and the data in the private market section will show you what's going on. Okay, Alec asks, do you see marked valuations changing from more developed secondary market in downturns? Great question. Okay, so a primary stock sale is when I, as a VC, go and buy a fraction of a company, let's say 20% of a company, and that company creates new shares and I get those shares. A secondary is if an employee, a founder, or even a VC decides to sell their current shares to somebody else. I think the secondary market is going to be vibrant, but it's going to be a distressed secondary market. So it's going to be VCs who need to sell, or founders who need to sell, or LPs who need to sell, and those will trade at significant discounts. And I think you're going to see that over the next 12 to 24 months. And so it's no longer like we used to have, a lot of companies used to have like standard secondary programs where employees every year could be able to take out like 15% of the then vested shares. I think it's unlikely we see that, and the secondary dollars go to this sort of more distressed category because the returns there are probably better. Okay, Jorg asks, if you can, should you wait to raise money? Great question, we're going to get there. And Matej, do you have a way to segment this data based on type of company? Yes, it specifically interested in data companies. We didn't ask the data at that granular level, so unfortunately I can't segment it, but there is a survey. I'm going to send out a survey at the end of this session, and if you have suggestions for how to improve either the questions that I asked or how to improve the whole session, please put it in there. Matej, please add that so we don't forget. Okay, cool. Let's see. Okay, as a result of what's going on in the market, 40% of founders are changing their fundraising plans. Jorg, this is your question. So 20% of them are raising sooner, about 20% are raising later, and about 60% aren't changing. And, you know, why is this? Well, Y Combinator and Sequoia, amongst others, have written letters encouraging founders to raise capital. And the goal there is you want to have about 24 months of runway. And the recommendation across lots of these different papers is three things, or come up with three plans. One is to get the cash flow break even / profitability ASAP. What would that mean? Do you need to cut like 30% of headcount, 50% of headcount? The second suggestion, which is sort of the base case, is have 24 months of runway. And then the third is, if everything turns out to be roses, how do we grow faster? And the goal of that scenario planning is make sure you have it in your pocket so that if you see a great growth signal, or on the opposite side, if you see pricing pressure or slowing sales cycles, you're in a position to be able to execute that plan in a really successful way. Okay, so why the 24-month number? Well, the two most similar recessions that happened in the United States economy were in 1940 and 1980. And the early 1980s recession lasted 18 months from July of 81 to November of 82. And the late 1940s recession lasted 11 months. So that's basically about 12 to 18 months. And so to have a little bit more buffer, most VCs are saying 24 months. It is important to point out that the recession is not tied to the stock market. And the stock market is the highest correlate to the venture market. So during those two recessions, the stock market actually went up 20% during the recession of 81, and it went up 30% during the late 1940s. Why is this? Well, there's stock buybacks. Stock markets try to predict stuff in the future, so there's anticipation of future growth. There's new industries, changing interest rates, lots of other macroeconomic factors. But at a whole, about 40% of founders are changing their fundraising plans. Awesome, John. Thanks for sending the survey. I'm not gonna be able to read it now, but I will read it later. Cool. Any questions on fundraising plans or dynamics around? There were a lot of questions around what you ought to do. What you ought to do about scenario planning. I think it's a good place to address them here if anybody's got them. Okay, Dharmesh asks, we are not in a recession yet. Do you think a VC-driven panic is going to make the recession come true? No, as much as we like to talk about how important we are, VC is not that big a part of the economy, and so things like consumer spending or like business spending are really what's going to drive a recession. And then Shannon asks, given valuations may be down, thought on resetting employee strike prices for retention? Yeah, this is starting to happen. So a bunch of companies in our portfolio, and I think broadly talking to different 409A valuation firms, are starting to reduce 409A prices by about 30%. And so the compensation committees, where the board members responsible for setting compensation, are starting to talk more and more about, hey, a lot of employees' options are underwater. What do we need to do in order to retain, in order to incentivize? And we're definitely starting to see people pop up their heads, and there's more liquidity in sort of the talent market than there has been in a long time because of the dynamics around the strike price. Okay, Matthew Fisher asks, how would you describe a changes in fundraising strategy for companies between product market fit and successful product? Okay, hold on. Questions are coming in fast. Wait. Hold on 1 second. Sorry about that. Okay. So how would you describe a change in fundraising strategy for companies in pre-product market fit versus successful product? Let's talk about that in a little bit. We'll talk about what's going on in the private markets, and then we'll talk about that question, Matthew, okay? And then Alec asks, should we expect material liquidation preferences to buoy ticket price valuations? I don't think we're going to see. So a liquidation preference is, when I joined the business, you have different kinds of stock. You can have like simple preferred, which is if I own 20%, it sells for 100 million, I get 20%. And then you get like things like participating preferred, where I would get my 20 back and then 20% of everything excess. So I'd actually make something close to $40 million on that transaction. We're not at that point yet where we're going to see sort of these pernicious investor terms. Alec, we got a bunch of ways to go. Okay, we got lots of questions. Time. Okay, we got 30 minutes. Alice asks, many economists believe the data doesn't support a recession, but the media is hyping up the fact that one is coming and it's shaking confidence. I don't think anybody knows, Alice. I think the big thing here that's really sort of a new dynamic is the quantitative tightening. So the Fed has increased its balance sheet in order to kind of buoy up the economy. And And they're, I think the rates is important, but like the reality is even if we get to 2% or 3% rates, that's what we had in 2018, and the multiples, if you remember in the first chart, were really good. The thing that nobody really understands is once the Fed stops rolling over a lot of the assets that it's bought, what is that going to do? You're seeing really funky dynamics in like the repo market hitting $2 trillion in overnight lending. And so systems are going to break or they're going to be really stressed. I think people are worried about that. There's also a bunch of the supply chain issues. You can look at the diaper crisis, and obviously that's not huge on GDP, but to your point, it's definitely shaking confidence. So I think this QE, that's what I'm paying attention to. And this is the first month where quantitative easing is stopping and we're doing quantitative tightening. And that's why I think so many of us are having these conversations. Okay, let's see. Okay, Mason asks, going back to changing the foreign NA price, a 30% decrease in strike price, is it for new employees or existing employees? It's typically what ends up happening is you set a 409A and then all the grants after that are then at that strike price. It can be a little bit more complicated. And so what ends up happening is like new employees get the benefit of that. And then a lot of the times the compensation committee then gives grants to existing employees or some subset of existing employees in order to make sure they continue to be motivated. Okay, we're gonna pause the questions there for a second just to keep going on the materials. Thanks, Mason. Okay, cool. Okay, we're almost at the last slide of the survey and then we'll rip through the questions again. Okay, here's what's interesting. So on the x-axis, you've got the total amount raised in millions of dollars by portfolio, by responding company. And on the y-axis, you have months of runway. The ones in orange are break even, right? So that's why they're at 100 because the survey max was 99. That way I could identify who was break even or close to it. And what's interesting here is there's no relationship between the amount of money that you've raised as a company and the runway. So people are kind of growing into bigger and bigger houses and they're investing more and more in growth. And so that's why the behavior within the market is largely going to be independent of stage. Cool. Okay, so one of the questions that we asked in the survey was, are you considering a new strategic option? Are you going to sell the company? Are you going to raise venture debt? Are you going to reduce your headcount? Are you going to raise an inside round? So what is an inside round? Well, an outside round is when I go as a founder and I go raise capital from investors who are not currently investors. An inside round is if I have investors already, I go ask them for more money. When I started in venture in 2008 and 2010, an inside round was a bad thing. It meant that the company went out to raise capital. It couldn't attract money from the outside. And so the inside investors had to finance the business. Recently, what's ended up happening is because venture capitalists have been raising more and more, and they've been raising funds across different stages, they invest in the Series A, then the Series B, then the Series C. And so a lot of inside rounds became a sign of strength because the VCs on the board have an information asymmetry and they say, this is a really exciting company, let's give them more money. Now I think we're going to get back to the point of an inside round is going to be more of a sign of weakness than a sign of strength, at least on a numbers count. And you can see here, a third of companies who participated in the survey are considering that, right? 24%, maybe a quarter of them are considering reducing headcount, and 21% are considering raising debt. That's basically another way of extending runway. About 10 to 12% are going to sell the company. The numbers here don't add up to 100 because you can answer in multiple ways. Most companies are actually considering multiple options. Okay. So how much are startups going to reduce their burn? On the whole, it's about 20%. Some companies are going to increase their burn, but the vast majority are actually going to cut their burn. So the question is, okay, how are you going to do this? The single largest expense for a company is headcount. And so the first place to look is there. Half of companies are not going to change compensation. 33% of companies are going to increase their compensation. About 17% of companies are going to decrease their compensation. But that's not enough to get to this 20% reduction in OPEX and operating expense. So it's layoffs. Most startups who want to reduce their operating expense by 20% are going to lay off. So are going to lay off about 20% of the company. So a fifth of companies are going to go through a layoff, and when they lay off, they're going to lay off about 20% of their staff. And that's how you get to a 20% reduction in OPEX. What's interesting here, and what a lot of people don't talk about, is The annual attrition rate of a startup is about 15%. So just current course and speed, a company will lose about 15% of its employees. So there's two different strategies in reducing headcount. You can basically just say, hey, we're going to keep going and we're going to lose 15% of our staff and we just won't hire their replacements. And then you get to a 15% reduction through the course of the year. The other way of doing it is doing a 20% reduction or so on one day. And different strategies apply to different companies, right? It might make more sense to do it all at once because then you get the benefit of the cost reduction for the full length of the year, as opposed to kind of doing it piecemeal. There are other kinds of, do you want the article about the layoff or not? What's the difference in morale? How do you communicate it internally? Those are all questions that companies should debate internally, but it's important to talk about those two strategies. So like when I read about a 10% layoff, to me, it's not that big of a deal because it's less than the annual attrition rate of the business anyway. Okay, on this slide, Shannon asks, has the attrition rate changed given the strength of the employee market? Post-COVID, we definitely saw maybe a 5 percentage point increase. So maybe if you were at 10, you went to 15, you were at 15, you went to 20, people wanting new things. My current hypothesis is that the attrition rate is actually going to decline because if there is a recession, I think going back to Alice's question, if there is a recession, then people are going to want certainty more than they're going to value the option of going to a different company. And so maybe they'll actually decline. Cool. Jason, hold on to that question. Once we get to the private market behavior, we'll talk about changing metrics. Actually, we're here. Okay, cool. So before we move on, any sort of, let's go through the questions, see if there are any other survey questions that we should talk about. Okay, Alice's question we talked about. Okay, Hamish asks, why don't you believe that VC dry powder will have a bigger impact on stabilizing VC valuations? Yeah, so you don't want to be the VC who does like a deal, like there's a high watermark in the market and then there's a correction, Hamish, and you don't want to be the person who does that deal. You'll be known for a long time. And so what ends up happening is there's going to be a fall and at some point it will stabilize, but the question is who's brave enough to sort of figure out like, oh, I'll be willing to make a bet on a 20% or on a 30% or on 40%. You have to defend it to your investment committee. Going back to that first story, right, where we were talking about the comps. And if the comps are down 70% and you come in saying, hey, it's 20% discount to market relative to the beginning of this year, you need a story, right? Like either this company has to be special and you can't do that many times. And so it's possible. But I think that's one of the mitigating factors to your question. Okay, Max asks, how do you see U.S. salaries changing given that changes happened around remote work and now more talent hitting the market? Look, salaries went up 7 to 15% last year, driven primarily by inflation. And so a lot of our companies increased salaries by that much. I don't see it. Inflation is 8% or so. The sort of consensus view is that it's probably a September spike and then it's going to fall. Maybe there's cost of living increases. I think given the macro backdrop, it's unlikely that it matches inflation. So I think they're basically holding flat. And if we go back to the survey data, where was that chart screen? Here we go. Half of companies are going to keep the comp the same. Okay. Ben asks, how do you navigate the need to extend runway versus still showing impressive enough growth to attract good investors? This is the conundrum. I think, so there's like there are two different strategies. There's an aggressive strategy, there's an aggressive strategy and there's a conservative strategy. And for most companies, we're recommending the conservative strategy. The aggressive strategy is have faith that the market is going to get back to a place where the most important thing is growth. And you might end up in a place where your valuation is significantly higher because you've outgrown your peers and multiples have recovered. And so you're in a great place. The safer bet is assume that the market is not going to come back, get to a place where you've got 24 months of runway and grow efficiently, continue to grow efficiently using that 24 months of runway. Wait till the market comes back, but always be in a position where you're controlling your own destiny so you're not dependent on raising around in a difficult circumstance. But Ben, you nailed it. Like this is the fundamental question that that most companies are asking and trying to answer in board meetings. Shalav asks, based on prior downturns, should we expect a significant spike in M&A of startups, of larger or public companies? Great question. So VMware was just acquired by Broadcom. It's the largest single software acquisition in history. It's pretty crazy. It happens during a 70% drop. But if you think about it, it makes sense. If you're a big software company with lots of cash and you've amassed lots of cash in the last decade, you're looking at a lot of these public software companies and they're basically buy one, get one free, right? They're 50 to 70% off. And so I think there's going to be a significant spike in take private M&A. Companies who are public, who are then taken private either through private equity or through strategic acquirers, because the public companies can't hide from their prices the way that the privates can. The private company can raise money, hold on to that valuation for 18 to 24 months, whereas the public company at the end of every day or even at the end of every minute, the price is the price, and anybody can submit a bid and then the board has to respond. And if you've looked at what's happened with Elon Musk and Twitter, it can be difficult. If you have a single buyer who offers a particular price and you can't get a second bidder, you're really kind of pressured into taking that acquisition, and if you don't, you're going to face lawsuits. So long-winded way of saying yes, I think particularly for the lower multiple companies or the companies that are down 50 to 70% and aren't growing that fast and have significant balance sheets or close to profitability, you see a lot of M&A there. Okay, cool. We've got 13 minutes. Awesome questions. I'm going to jump into the private data and then we'll go through the remaining questions. Okay, private market behavior. Okay, so here we've got a chart that shows the seed, the Series A, the Series B, Series C, and Series D by round count. And the blue line going through the chart for each of these is a linear regression. So just like a very, very simple model. And it shows that, seed is basically relatively constant. There's definitely that spike there in the early part of the year, but basically on track. If you look at the others, the round counts are down somewhere between 10 to 20%, maybe more. And this data, I can tell you this is what the market feels like. It used to be that we would have like 4 or 5 companies per week in a partner meeting. Now we're maybe seeing 1 or 2. Processes are definitely taking longer, which is another thing to think about as you're a founder. It used to be a super fast process. It was a couple days, and like the median process might have been 2 weeks, and now it's a couple weeks. And in 2008, right after Lehman fell, it was like a couple months, maybe even 3 months to raise. So something to keep in the back of your mind. So here's what's interesting. So you got round sizes decreasing, same chart, same layout, but this is for mean round sizes, the average round size. They really haven't changed. Like you look at the Series A, it's basically on track. You look at the Series B, it's kind of, they're basically all within the line. Series C is actually above the trend line. So, and the pre-money valuations also really haven't moved. Look at seed, all right, it's kind of spiking, right? Way above trend line. Series A is above trend line, B is above trend line, C is above trend line, D is above trend line. Why? There are fewer rounds, but the round sizes are the same and the prices are the same or better. There is a flight to the best companies, right? Venture capitalists still need to deploy capital. They're being much more selective about which companies they go into. And for the companies that they're going into, those are super competitive. Auction pressure creates bigger rounds and higher prices. And so that's the dynamic that's going on in the private market today. This data is going to lag. So the companies that, if you're a company with 18 to 24 months of cash and you don't have the metrics, you don't have the growth, you don't have the efficiency to raise capital, you're not going to appear in these numbers for 12 to 18 months, right? So if we look at the PitchBook data, if we look at the Crunchbase data, it's one thing to look at it and see it, but the reality is there's a whole segment of the population that exists here within this data and the trailing data that's not going to exist in the go-forward data for at least a year. And so you can't look at these numbers and bring them to the office of your local VC and like, this is the price that I deserve, or this is the market clearing price. Cool. Okay. Awesome. Okay. So before we hit the summary, let's run through a bunch more questions. Let's see. Jason asks, thanks for your patience, Jason. If you're going to rank your top 3 to 5 metrics 12 months ago versus now, how would they differ? Metrics are the same. ARR growth, net dollar retention, sales efficiency. The thing is, the bands are different, right? So ARR, I think, is going to come down like top decile from like 1 to 6, 1 to 7 to probably like 1 to 3, 1 to 5. The sales efficiency, companies with, so the sales efficiency and paybacks are inverses. So are inverses of each other. So you just 1 over 1 gives you the other. So, when we did the 2020 go-to-market survey, most companies, most software companies were between an 14 to 18 month payback on the private side at the Series A. The more you target enterprises, the bigger it is. The more you go consumer, the less it is. But let's just say it's 18 to 24 months. I definitely think like if you're at 24 months or 36 months or somewhere in there, it's going to be much harder. That efficiency number is going to be much more important. And so maybe you'll see a resurgence in like PLG or super capital efficient businesses again. And then on net dollar retention, look, I think it's, if there truly is a recession, we're going to see churn, right? We're going to see pricing pressure and reduction and people going through their software budgets and looking and rationalizing, look, we've got 15 too many MailChimp seats or whatever it is. And so those, you've got Snowflake at 171% NDR, which is at scale, which is super impressive. That's a high watermark. Most companies, the 50th percentile when we did in 2020 was about 120%. Top decile was 140%. I think those numbers are going to shift down just as a result of logo churn. Okay, Luis, my man, old friend. Also, on the dry powder side, funds over the last couple of years were contracting their investment period to 1 to 1.5 years. LPs are expecting it to return to the usual 3 years. That's absolutely right. So to fill everybody in, say, Luis goes out to raise a venture fund tomorrow, he's going to raise that fund for 10 years. And typically, over the course of venture, VCs have said that we're going to take that fund and invest it over 3 years. But as the market got really hot, we as a group started investing it faster and faster because we were writing bigger checks faster and faster. And so instead of investing it over 3 years, we were investing it 1 year. And so that dry powder now, we were looking at it like you raise whatever. I mean, we invested as a group $330 billion last year. We're going to spread it out over twice the period of time. And so the total volume, the total deal volume, the dollars being invested in startups should decrease pretty meaningfully. The other thing at play here is that about 80% of the dollars invested last year, that $330 billion, so about $200 billion of it was invested by non-traditional VCs like hedge funds and that crew. And that money can move really quickly in and out of the ecosystem. So if you see half of that go away, you're talking about a 50% reduction of 200 billion, 100 billion that was invested last year could conceivably be gone. So we could see a pretty significant contraction, I think, in the back half of this year in the total dollars invested in startups. But it really depends. It's hard to predict. Okay, Richard says, seems like an argument that a strong early stage opportunity will have an unusual ability to attract top talent over the coming 12 months. Do you agree with that assessment? I do. I think the companies that are able to continue to raise significant rounds are going to have, just the way that VCs are kind of going to the companies where they're perceived winners or actual winners, the talent's going to do the same thing. So right on point. Okay, Luis, follow-up question. Lots of startups have other startups as a key segment. How should revenue projections for that segment be adjusted? This is a great question. So one of the things that happened in the dot-com era is that startups were selling to each other. And as the ecosystem fell, there was these sort of like reinforcing effects where the customer base has collapsed. And so the revenue just fell out from the bottom. That could be the case here, right? And so monitoring the health of your of your customer base is an absolutely critical thing to do. Again, going back to that index of Salesforce and all the infrastructure companies, that's why I pay attention to those metrics in the public market, because that's a nice broad index. And in startup land, looking at layoffs.fyi or reading on TechCrunch about what's going on within your largest customers, particularly if you have significant customer concentration risk, is an important thing it's an important practice. Amazing. Okay, cool. So to summarize, most founders are neutral on the market, actually a little more bullish than our audience here. A little less bullish, a little more bullish than our audience here. SaaS and infrastructure companies are the most bullish. Web3 crypto, the least bullish. 20% of the startups that we polled plan a layoff on average of about 20% in order to reduce that OpEx. And I think it's primarily driven by this goal of getting to 24 months of runway. 40% of founders have changed fundraising plans. But the reality is the private market hasn't corrected as much as the public, and it's still pretty murky because the data is actually lagging reality. And so one of the things that I love to do every year was go through all the companies that we've met and benchmark, what is a Series A? And I went back and I looked at 2017, 2019. A Series A company in the software business probably had somewhere between $500,000 to $1 million in ARR on average. There are exceptions, but on average they sort of look like that. in the last 2 years, it was literally like went to 100K to 200K. And today, I can't tell you. I can't tell you because one, there aren't enough transactions yet in order to give you sort of a range, and also there, even the multiples are kind of all over the place. So when will we have data? My sense is we'll probably have data like at the end of Q3, so October, November-ish, when we have enough transactions to actually see what's going on in the market. And it's probably one of the reasons why so many founders are changing their fundraising plans. Yeah, fantastic. Okay, any other questions before we wrap up? Oh, here we go. Billy Robbins asks, do you think PE companies will do a big roll-up later this year once companies come to terms with the new normal on multiples? I do think that. I think debt, even with interest rates going up, is still relatively attractive at 2 or 3%. So maybe you're paying 5 to 7% as a PE company in order to acquire a business. And a lot of people are going to be frustrated with the money that they thought they had, but now all of a sudden multiples are down, so they're going to look to sell. Awesome. Ashley asks, will the recording of the session be available? Yes, it will. We will publish it soon. I'm hoping next week. Awesome. Any other questions? Fantastic. So I will publish the slides today on the blog. I'm so grateful to everybody who attended this session of Office Hours, and thank you for all of the incredible questions. I will be sending out a survey. If you have ideas for topics, what you want to talk about, what you want to hear about, let me know. And if you have ideas for how to improve the session, throw those in there too. But have a wonderful weekend, everybody, and thank you so much. It's been great. Oh, Scott saw the cameo. Awesome. All right, everybody. Have a good weekend. See you.